60 minutes, that's all it took. Gold collapsed from $5,600 to $5,100. Silver plummeted from $121 to $100. $6 trillion in wealth simply erased. January 29th, 2026, 10:30 a.m. Eastern Time. The crash began, but here's what the financial media won't tell you. This wasn't random. This wasn't unexpected. And if you don't understand what triggered this collapse, you'll be destroyed by the next one. December 2025. The exact same pattern occurred. What followed? The largest monthly rally in 4 decades. So the question every serious investor is asking right now, is this the end or the beginning of something far bigger? By the end of this analysis, you'll know exactly what caused this systematic wealth transfer. And more importantly, what happens next. Welcome to Silver Radar. If you've been navigating financial markets for decades, if you remember when information wasn't instant, when analysis required patience and discipline, then you understand the value of strategic economic intelligence. This channel exists for those who prefer substance over sensation, for decision makers who've learned that wealth preservation requires understanding mechanisms, not following crowds. If that describes your approach to financial strategy, I'd respectfully invite you to subscribe. Not because we chase trends, but because we analyze systems. And before we continue, I'm curious, from which corner of the world are you watching this analysis? Are you observing these market dynamics from North America, Europe, Asia, or elsewhere? Drop your location in the comments. It provides valuable context on how these global economic shifts are being perceived across different regions. Now, let's examine exactly what happened on January 29th, and why the $6 trillion evaporation was entirely predictable to those monitoring the right indicators. January 29th, 2026, 10:30 a.m. Eastern Time. Gold was trading at $5,600 per ounce. Silver sat at $120. Institutional traders were monitoring their screens. Retail investors were checking their portfolios. Everything appeared stable. Then the collapse began. 60 minutes later, gold had plummeted to $5,100. Silver had crashed to $100 more dollars. $500 vanished from gold's value. $13 erased from silver. In the time required to conduct a standard business meeting, $6 trillion in asset value had evaporated from global markets. But here's what separates this event from ordinary market volatility. This wasn't a gradual decline. This wasn't a measured correction. This was a systematic cascade, a deliberate unwinding of over-leveraged positions, a textbook example of how modern financial markets transfer wealth from the unprepared to the positioned. Consider the mathematics of destruction. An investor holding $100,000 in silver at the peak. 60 minutes later held $89,000. $11,000 gone. Not over weeks, not over days. In less time than a standard lunch break. But the real devastation occurred among leveraged traders, those utilizing margin, those holding options contracts expiring within days, those who believed their stop-loss orders would protect them. For these participants, the collapse was catastrophic. Here's how the cascade mechanism functions. When prices decline rapidly, leveraged positions trigger margin calls. Traders receive automatic notifications, deposit more capital or face liquidation. Most cannot deposit additional funds quickly enough. Their positions are automatically sold. Regardless of price, this forced selling drives prices lower, which triggers additional margin calls, which forces more selling, which drives prices even lower. The cascade becomes self-perpetuating. Each wave of liquidations creates the next wave, like dominoes falling in precise sequence, except these dominoes represent people's capital, businesses' reserves, retirement portfolios. And here's the critical distinction that most analysts miss. This cascade didn't originate from fundamental weakness in gold or silver. The metals themselves hadn't suddenly lost value. Mine production hadn't surged. Industrial demand hadn't collapsed overnight. Central banks hadn't reversed their accumulation strategies. The crash originated from an entirely different source, one that most retail investors never monitor, one that institutional traders watch obsessively, one that predicts precious metal movements before they occur. Professional traders understood what was happening. They saw the warning signals hours before the collapse. They repositioned their portfolios. They closed vulnerable positions. They prepared to acquire assets at depressed prices, while retail investors, unaware of the actual mechanism, watched their screens in confusion as red candles accumulated. This information asymmetry isn't accidental, it's structural. It's how financial markets have always operated. The question isn't whether this asymmetry exists. The question is, which side of the asymmetry are you positioned on? Now, before we identify the hidden mechanism that triggered this collapse, we must address the pattern that makes this moment critically important. December 30th and 31st, 2025. Less than 30 days before today's crash, an almost identical event occurred. Sharp sell-off. Cascading liquidations. Maximum fear across precious metals markets. Social media filled with predictions of collapse. Financial commentators declared the bull market terminated. Retail investors capitulated, selling at the bottom. Then January arrived. What followed shocked even seasoned analysts. Gold surged 30% in a single month. Silver exploded 65%. Record highs weren't just broken. They were shattered. The largest monthly rally in over 40 years. Every investor who panicked in December. Every trader who sold at the bottom. Every portfolio manager who advised clients to exit. They watched the rocket launch without them. They transferred their wealth to those who understood the pattern. And now, 60 days later, 2 days before January's conclusion, the exact same pattern emerges. Sharp crash, cascading liquidations, maximum fear. The parallel is striking. December crashed. January exploded. January crashes. February approaches. This raises the fundamental question that every serious investor must answer. Is this crash the terminal event or the accumulation opportunity? Is this the end of the bull market or the shakeout before the next advance? Is this when you panic or when you prepare? The answer lies not in emotion, not in hope, not in following the crowd's sentiment. The answer lies in understanding the mechanism, in identifying what actually moves gold and silver prices, in recognizing the invisible force that professional traders monitor constantly, while retail investors stare at metal charts alone. That force has a name. That mechanism operates with mathematical precision. And once you understand it, every precious metals movement becomes predictable. Every crash becomes interpretable. Every rally becomes anticipated. But to understand this mechanism, we must first examine what 90% of investors completely ignore. The invisible driver behind every major precious metals movement. While retail investors stared at plummeting gold and silver charts, professional traders were watching something entirely different. A 3-letter code that controls billions in precious metals movements, yet 90% of investors have never heard of it. The DXY, the dollar index, the invisible puppet master pulling every string in the precious metals market. This isn't some obscure indicator. This is the primary force that institutional traders monitor before making any metals trade. The DXY measures the US dollar's strength against a basket of 6 major world currencies: the euro, Japanese yen, British pound, Canadian dollar, Swedish krona, Swiss franc. And when these currencies weaken against the dollar, the DXY number rises. When these currencies strengthen, the DXY number falls. Simple mathematics. But the implications are profound. Because here's what most investors never learn. Gold and silver move inversely to the dollar with near-perfect correlation. Not sometimes, not occasionally, almost always. When the DXY rises by 2%, gold typically falls 3 to 5%. When the DXY drops by 3%, silver often surges 6 to 9%. This relationship is mathematical, structural, predictable. Imagine a perfectly balanced seesaw on a playground. The dollar sits firmly on one side, gold and silver rest on the opposite side. When dollar strength pushes that side upward, the metal side must descend. When dollar weakness drops that side downward, the metal side must rise. They cannot both ascend simultaneously. Physics doesn't allow it, economics doesn't permit it. Today, January 29th, the DXY surged dramatically. The dollar side of the seesaw rocketed upward, driven by forces we'll examine shortly. And gold and silver, having no choice, crashed downward with mathematical precision. Professional traders saw the DXY movement at 9 GOR-AM, 1 full hour before metals crashed. They sold their metal positions, moved to cash, prepared to buy at lower prices. Retail investors, monitoring only gold and silver charts, never saw the warning signal. By the time they noticed the red candles forming, institutions had already exited. By the time panic set in, by the time stop losses triggered, retail investors were selling to the very institutions who'd exited earlier. This is the fundamental information asymmetry that governs precious metals markets. Institutions watch the cause, the DXY. Retail watches the effect, the metal prices, because always precedes effect. Those monitoring cause always move first. Those monitoring only effect always react late, always buy high, always sell low. This isn't manipulation. This isn't conspiracy. This is basic market structure that separates informed capital from uninformed capital. The DXY metal's inverse correlation is held for decades, through every administration, through every crisis, through every bull and bear market. It's as reliable as gravity, as predictable as sunrise. Yet financial media never discusses it. Investment advisors rarely mention it. Retail platforms don't highlight it. Why? Because informed investors are more difficult to extract wealth from. The system benefits when retail investors remain focused on the wrong indicators. Today, the $6 trillion wealth transfer happened precisely because most investors were watching metal charts while professionals were watching the dollar. The seesaw moved, only one side saw it coming. Now here's where this becomes critically important for your strategic positioning. If you understand that metals move inverse to the dollar, then predicting metals movements becomes straightforward. Don't ask, will gold rise tomorrow? Ask, will the dollar weaken tomorrow? Don't ask, is silver going to crash? Ask, is the dollar about to surge? The correct question changes everything, but this raises the most important question of all. Why did the dollar surge so dramatically today? What force was powerful enough to spike the DXY, crash $6 trillion in metals, and create the largest single-day liquidation event in months? The answer isn't one force. It's three converging simultaneously, three separate storms that merged into a perfect financial hurricane. Three forces, each powerful enough to move markets independently, collided on January 29th with devastating precision. The first storm had been building for months, originating from the marble halls of the Federal Reserve in Washington, D.C. The institution that controls the world's reserve currency was sending signals that most investors misinterpreted. Throughout 2025, markets anticipated aggressive rate cuts, a return to easy monetary policy, a dovish pivot that would weaken the dollar. The Fed had other plans. Interest rates remained elevated, far higher than market expectations, far longer than analysts predicted. Jerome Powell and the Federal Open Market Committee faced a dilemma: inflation showing signs of resurgence, economic data remaining surprisingly resilient. Cutting rates prematurely risked reigniting inflation. Maintaining elevated rates risked market disruption. They chose inflation control over market comfort. Here's why this matters for the dollar, and consequently for precious metals. When U.S. interest rates rise or remain elevated, Treasury bonds offer higher yields. Foreign capital flows toward dollar-denominated assets. A German investor holding euros, a Japanese pension fund managing yen, a Middle Eastern sovereign wealth fund with multiple currencies, all face the same calculation. Higher U.S. yields mean better returns on dollar investments. They convert their currencies into dollars, buy Treasury bonds, capture the yield differential. This demand for dollars drives the DXY upward, which mechanically drives precious metals downward. The Fed's hawkish stance wasn't temporary messaging. It was structural policy, and the currency markets responded accordingly. Storm 1 delivered its impact, but the hurricane was only beginning to form. The second storm emerged from the industrial heartland of the world's second largest economy, China. January's economic data revealed something Western analysts had suspected, but Chinese officials had obscured. Manufacturing contraction was accelerating. Factory purchasing managers, indices falling below 50, indicating contraction rather than expansion. Industrial output declining month over month, export orders softening, production capacity sitting idle. For most commodities, Chinese slowdown creates bearish pressure. But for silver, the implications are particularly severe. Silver occupies a unique position in commodity markets. It's simultaneously a precious metal and an industrial metal. Roughly 56% of annual silver demand derives from industrial applications, not investment, not jewelry, industrial consumption. Solar panel manufacturing consumes massive silver quantities, each panel requiring silver paste for conductivity. Electronics production demands silver. Smartphones, laptops, tablets all contain silver components. Electric vehicle manufacturing uses substantially more silver than traditional combustion vehicles. The electrical systems require superior conductivity. Semiconductor fabrication, 5G infrastructure, medical devices, all silver-intensive industries. And where does the majority of this manufacturing occur? China. When Chinese factories slow, when production lines operate below capacity, industrial silver demand projections deteriorate. The market doesn't wait for actual demand decline. It trades on anticipated demand reduction. This explains why silver crashed 11% while gold dropped only 9%. The industrial component of silver created additional downward pressure. Gold, as purely precious metal, responded only to dollar strength. Silver, as hybrid precious industrial metal, responded to both dollar strength and industrial demand fears. Storm 2 amplified the damage, but the third storm provided the psychological trigger. Political dysfunction in Washington reached critical mass as January concluded. The federal government faced a funding deadline, January 31st, less than 48 hours away. Congressional negotiations had stalled, partisan disagreements preventing resolution, shutdown appearing increasingly probable. Government shutdowns historically create market uncertainty, not because they fundamentally alter economic conditions, but because markets despise political unpredictability. After January's extraordinary rally, gold up 30%, silver up 65%, substantial profits existed across precious metals portfolios. Institutional traders holding significant gains, faced with political uncertainty, recognized an opportunity to de-risk. The shutdown fears didn't cause the crash. They provided psychological permission for profit-taking, a convenient narrative for exiting positions that had become extended, overbought, vulnerable to correction. When the dollar surged from Fed hawkishness and China concerns, the shutdown fears gave traders justification to sell aggressively rather than moderately. Three storms converging: Fed policy maintaining dollar strength, China data undermining industrial demand, political uncertainty triggering profit-taking. Each storm individually might have caused a 2 to 3% correction. All three simultaneously created a 9-11% collapse in 60 minutes. But here's what separates strategic investors from reactive traders. This exact pattern, this precise convergence, happened before, not years ago, not in some distant historical parallel, 30 days ago, December 30th and 31st, 2025, the final 2 trading days of the year. Identical crash, identical panic, identical liquidations. And what followed that December catastrophe? The largest monthly precious metals rally in 4 decades. December 30th, 2025. Markets were closing out the year when chaos erupted. Gold plummeted without warning. Silver cascaded downward. Liquidations triggered more liquidations. The pattern mirrored today's collapse with eerie precision. Same velocity, same panic, same forced selling. Financial media declared the precious metals bull market terminated. Analysts revised forecasts downward. Retail investors capitulated. Social platforms filled with declarations of defeat. I'm out. This is over. The top is in. Those who sold on December 31st locked in their losses, transferred their positions to institutions accumulating at depressed prices. Then January 1st arrived, and everything changed. Gold began climbing, tentatively at first, then with increasing momentum. Silver followed with amplified intensity. The industrial precious hybrid responding to renewed optimism. By January 15th, the rally had exceeded all expectations. By January 29th, before today's crash, gold had surged 30% from December lows. Silver had exploded 65%, the largest single-month gain in over 40 years. Every investor who panicked in December, every trader who sold at the bottom, watched the ascent from the sidelines. They had transferred their wealth to those who understood that crashes within bull markets create accumulation opportunities, not exit signals. Now, January 29th, 2 days before month's end, history appears to be repeating with mathematical precision. Sharp crash, cascading liquidations, maximum fear returning to precious metals markets. The parallel is undeniable. December crashed at month end. January exploded afterward. January crashes at month end. February approaches. Pattern recognition suggests repetition, though markets never guarantee anything. But here's what hasn't changed despite today's $6 trillion evaporation. The structural fundamentals supporting precious metals remain completely intact. Central bank gold purchases continue unabated, Tether acquiring 1 to 2 tons weekly regardless of price fluctuations. BRICS nations, Brazil, Russia, India, China, South Africa, accelerating gold accumulation as de-dollarization policy intensifies. The global monetary system's gradual shift away from dollar dominance, proceeding exactly as predicted. Today's dollar strength representing temporary surge within longer-term decline. Silver's supply deficit entering its 6th consecutive year. Mine production failing to meet industrial and investment demand. Existing above-ground stockpiles depleting. No major new discoveries coming online. Supply constraints tightening annually. These fundamentals didn't reverse in 60 minutes. They didn't change because sentiment shifted. They remained structurally bullish. What changed today was emotion. Fear replacing greed. Panic replacing confidence. But emotion is temporary. Fundamentals are enduring. This creates 3 potential scenarios for the weeks ahead, each with distinct probability and strategic implication. Scenario 1, bull market continuation. Probability approximately 60%. Today's crash functions identically to December's, a violent shakeout removing weak hands before the next advance. February begins recovery phase. March establishes new highs. Silver targets $150. Gold targets $6,000. Supporting evidence. Unchanged fundamentals. Historical pattern precedent. Extreme oversold technical conditions. Scenario 2, extended correction phase. Probability approximately 30%. Fed maintains hawkish rhetoric longer than anticipated. Dollar strength persists. China data deteriorates further. Gold tests support at $4,800. Silver probes $90 levels. Consolidation extends through February into March. Supporting evidence, macro uncertainty, potential technical breakdown, institutional caution. Scenario 3, sideways consolidation. Probability approximately 10%. Neither breakout nor breakdown. frustrating range-bound movement, retail exhaustion, volume contraction. Markets digest January's gains, await clearer directional catalysts. Major move occurs only when attention shifts elsewhere. Now, strategic positioning based on current circumstances. For those holding physical precious metals, no action required. Physical gold and silver function as long-term wealth preservation, not trading vehicles sensitive to short-term volatility. The ounces owned remain constant. Only dollar-denominated pricing fluctuates. And dollar-denominated pricing is irrelevant for multi-year holdings. For leveraged traders, today delivered an unambiguous message. Reduce leverage dramatically or eliminate entirely. Gap movements bypass stop-loss protections. Forced liquidations occur at prices far worse than anticipated. Account destruction happens faster than human reaction time allows. The asymmetric risk vastly exceeds potential returns in volatile precious metals markets. For cash-positioned observers, maximum fear events create optimal accumulation windows. Wealth transfers from the panicked to the prepared, from the emotional to the analytical, from those reacting to those strategically positioning. Accumulate in tranches, not single positions. Deploy only capital with multi-year time horizon. Ignore short-term fluctuations. The fundamental question every investor must answer. Markets systematically transfer wealth from the impatient to the patient, from those who react to those who prepare. Today, January 29th, 2026, $6 trillion changed hands in 60 minutes. Some participants lost that capital. Other participants gained it. The difference wasn't intelligence, wasn't luck, wasn't market manipulation. The difference was preparation, understanding mechanism over emotion, monitoring cause rather than effect, recognizing patterns rather than panicking at volatility. December crashed. January surged 30 to 65%. January crashes. February arrives in 48 hours. The pattern sits before us. Clear, documented, measurable. Whether it repeats, whether February delivers another historic rally, remains uncertain. But one certainty exists. Those who understand the mechanism will be positioned correctly regardless of which scenario unfolds.